will talk about what's coming in the next months and what we need to pay attention to. But on the top of it, we'll discuss what makes the most sense and how to prepare going forward. I think that's most important. Tax advice can be approached from two different standpoints. One is the tax advice usually is appropriate when people have multiple rental properties. They have maybe different type of compensation. So tax planning advice, even though you might have to pay for tax preparation, you need to look not just for tax preparation, somebody who can do tax planning. And if your tax person doesn't do it, either look for someone who does, or even better, look for financial planner who has a background in it. So let's talk about several different sources of, your tax preparation and what we need to look into first. It's your ordinary income. So
excuse me, Larissa, sorry to interrupt, but can you show it with slideshow view?
Oh, yes, sorry, I got back into the other one. Yes, absolutely. Here we go. Okay. Like this. Okay, perfect.
Thank you.
So we'll talk about different steps. So first we'll address ordinary income. What's the income would be? What's the tax bracket? So 2024, you can see that the tax bracket hasn't really changed much. The numbers moved slightly higher, but by inflation, but not a lot. So you can see that people who are married, they will expect to pay be in a tax bracket of 22% once they get over $94,000. So pretty quick, you get into that tax bracket. That's already pretty high. And then the highest tax bracket is 37% these days. So there is no higher than that. And between single individual married couple, there's usually about $100,000 difference on the tax brackets as we move along. So married couple enjoy a better tax bracket, single people enjoy a not as favorable tax bracket. If you know what is the worst tax bracket we can ever file under, anybody has an idea? It is married filing separately. Most of the time, unless you make over $2 million, married filing separately, it's not a good filing status unless there are some advantages to do so, which we can discuss separately if your income falls over $2.5 million. Most of the time, if you're married, you need to file jointly to save on taxes. The next favorable bracket after that is head of household. People who qualify will get a better tax rate than a single filer, and then married filing separately would be the worst tax bracket. So it's good to keep in mind filing status is important. You need to plan for it, especially if you're moving, if you're getting divorced and all that. You need to really plan for it accordingly over time. So I would suggest definitely look into that sooner. Medicare, hospitals, so we call it surtax, Affordable Care Act tax that's been enacted. It is assessed on specific income. For instance, Medicare surtax, which is 3.8%, is assessed on interest, dividends, net capital gains on your net investment income. So that tax is not assessed on your ordinary income, but we need to keep in mind, once your net investment income goes above it, you'll be subject to that tax. People who sell the property in a year and assume more than $200,000 in capital gains, they will have to pay this extra tax. Medicare hospital tax, also not a fun tax to pay. It's also assessed on the aging compensation. And it is, I believe your threshold has to be way above $1 million to be subject to that, but it's also there. Not a lot of people know about it. So that Medicare hospital tax, sometimes very difficult to avoid for top earners. Exemptions in the brackets. So filing status, so we can see here that we have certain phase-out amounts. And you can see that depending on a different filing status, your phase-out ranges changes. Very important to notice that the highest rate we'll ever pay for certain income, for instance, we'll talk about capital gain tax. Capital gain tax is extremely important tax to plan for, because if you're declaring income over a certain, I'll show you something in a minute. If you're declaring, and we'll talk about conversions as well, if you're declaring income of over 500, below $580,000 as a married filing jointly, and part of that income is a capital gain, all your capital gain tax will be at 15% rate. If your income as a married filing jointly in 2024 over $580,000, all of your capital gain, long-term capital gain tax rate will be at 20%. So when you're considering selling stocks, when you're considering selling property, in deciding which year will be best to sell, you need to really pay attention to your brackets, because if you don't, instead of paying 15% capital gain tax, you might end up paying 20%. And this is just the federal level, right? And then remember, you'll have to pay 3.8% Medicare surtax, and it goes on and on. So tax planning, it becomes extremely important at that time. So let's talk about how do we shift between a lower tax year and a higher tax year. This is one of the best strategies you can employ in the future, especially if you know if you have a lower income going forward, maybe in the next couple of years. So what can we do? What can we really do? In a year where you're in a higher tax bracket, you're in a higher income level, but whatever reason, you got a bonus, you have some, maybe you got them laid off and you have like a golden parachute, or you have a severance pay. That's a high year where you really want to increase your increase your contributions into all your retirement plans. Let's say you're working, you need to make sure you max your 401k. If your spouse is not working, but and it doesn't have ability to put money in 401k, maybe she's eligible for spousal deductible IRA. You need to make sure if you're making charitable contributions, maybe it does not make sense to make them every single year. Maybe it makes sense to lump them up together to get to a itemized deduction level. And a lot of my clients do that. Instead of doing donations every single year, they lump sum them and do it every other year. So the ordinary income decreases because your itemized deduction goes higher due to your charitable contributions. So in the higher year, like, you're getting extra bonuses, try to avoid selling any stocks, try to avoid recognizing gains as well. Retirement account distributions usually are very well controlled till age of 73, when required minimum distribution starts to be needed to be taken out, and used to be 70 and a half year after you reach age of 70 and a half. Now it's year after you reach age of 73. What does it mean to us? It means that if you retire at 67 and you have other sources of income, let's say your stocks, your non-retirement assets, then you might not want to touch retirement assets. You might want to leave them alone till RMDs are due. And if you have a sizable brokerage account, then it's probably better to take money out of that account, pay capital gain rate, which could be much, much lower than your ordinary income tax. So controlling ordinary income tax bracket in a higher tax year is very important. And there is a way to do it through either less realizing income or through increasing your itemized deductions, charitable contributions. If you're moving between states, you can deduct certain expenses of the moving and part of your itemized deduction. So controlling the tax year is very important. You need to start doing it at the beginning of the year. We usually do our reviews in January to see, is there any potential opportunity to cut on your tax bracket? Think about those people who already retired. If you're under Medicare, it's very important for you to control your income level each year, because otherwise you'll be subject to IRMA, increased Medicare premiums, and they go up pretty quick. For instance, married filing jointly, if their income is going above $190,000, they're subject to increased Medicare premium Part B and Part D. So something to keep in mind. Lower tax year, let's say you worked only half year, maybe you were laid off, maybe there is something else happened that you don't have a full income for this particular year. Couple of opportunities exist. First is realize some capital gains, right? Pay lower tax rate for that. Do Roth conversions. If you're always been making $200,000 and suddenly this year is only 75 and you have a sizable 401k, consider 401k to IRA rollover and then IRA to Roth conversion to convert part of your IRA below certain tax brackets and move some money from IRA to Roth at the lower tax rate. As a result, you will see your Roth account grows tax-free for the rest of the time. Defer charitable giving. If it's a lower tax year, maybe it's not advantageous for you to do so if you can afford it. I'll accelerate income recognitions. A lot of it has to do with stock options, but not only that. Sometimes if you get certain bonuses that can be stretched out. Sometimes if you want to sell stock options and you have an ability to sell them in the following year, you can maybe accelerate and sell them now. Reduce your stock exposure if that's necessary. So try to realize as much income as possible in a lower tax year, not to squander your ability to pay lower tax. A lot of my clients who retire mid-year, they understand that their tax brackets will be lower. At that time, we do special planning to see what kind of income realization can we do that particular year and pay lower taxes than the following year. So this shifts between two different types of income is extremely important to do. What items affect your taxable income? And I'm going pretty fast, so if there is any questions, please, I'm happy to answer as we're on the slide, if they're related to this particular slide or topic. Items affected by taxable income. So obviously, we know that we have capital gains tax bracket that affects your income immediately. If you make an ordinary income and on top of it, you sold some stocks, you'll be paying taxes on those gains at the same year. Let's talk about another item that's very popular with retirees is Social Security. A lot of people believe that they already pay taxes and they shouldn't get taxed on Social Security benefits, but unfortunately, it's not true. If your income is over $50,000 or $60,000, then more than 85% of your Social Security benefits will be taxed. You need to make very little money, probably below $40,000 a year, in order for Social Security not to be taxed or not to be fully taxed. So please be prepared that 85% of your Social Security will be taxed, most likely if you live in this area, which is expensive. And Social Security usually represent only 1/3 of your overall income needed in retirement. Okay, so now let's discuss how retirement assets play in your tax brackets. And I will share with you a couple of very popular ways to do it, but there are a few others that people don't know about it, and I will definitely address that as well. So traditional IRAs usually are not available to most people here because the AGI phase-out limits is very, very low. If you are not contributing into the 401k, if you're not making a contribution into 401k and you're not eligible to make that, then you have a higher chance to make a traditional IRA contributions if you have ordinary income. Please remember, only ordinary income that you earn will be available for your contribution in traditional IRA. If you don't have ordinary income, you have rental income, you have capital gains. Those are not active income or ordinary income that we can use to make the deductible contribution. Only income that is earned can be used to make IRA contributions. Same applies for Roth. Roth thresholds are a little bit higher. You can see that for married couple it's 240,000, but a lot of people who work, they're not eligible to make Roth IRA contributions. A lot of people come to me and say, well, since I'm not eligible for Roth IRA contributions directly, can I just make Roth 401k contribution? And this person is in a 25% tax bracket. The answer is no, because you want to do all of your pre-tax contributions into 401k, which this year is 20,500. People over 50, it's 30,000, I believe, 500. And it just went up by $500. If you make a pre-tax contribution to 401k, entire 20,500, or if you're over 50, 30,500 will be tax deductible. If you make any Roth 401k contributions at that time, you are not going to be able to deduct. Let's say if you put $5,000 into Roth 401k, rest on deductible, your deductions now is limited only to $25,000. Not a good idea. My idea is always to minimize your tax bracket, which means we make the maximum contribution into your 401k, which is deductible, it's 30,500 for folks like me, over 50. And then you do something called after-tax contribution. After-tax contribution is the amount of money that you can put away based on your total contributions available for qualified plans. What does it mean? It means that each year between you and your employer, you're eligible to put away, let's say, $67,000. I believe this year is 68. $68,000 will be calculated like this. 30,000 will go into your pre-tax 401k, becomes tax deductible. But what about the remaining 30-some thousand dollars? Well, your employer will make a contribution on your behalf, which would be the matching contribution into 401k, let's say 10,000. Now, the total amount that went into your retirement plan is, let's say, $40,000, but you're eligible for 68. So you still have $28,000 available. And what is this availability? How this availability can be used? It can be used for after-tax contributions, and it can be immediately rolled into your Roth 401k. As a result, you didn't use up your pre-tax money in 401k, you're using after-tax feature. So if your employer has ability for you to make an after-tax contribution and then roll into the Roth, it will be a fantastic way for you to start making contributions to the Roth indirectly. What's the beauty of the Roth accounts? So Roth 401k, Roth IRA, those both are growing tax-free. So if you're 50 years old and you put money into your after-tax 401k and then roll it into the Roth immediately, ideally you do it every paycheck, then all the money will grow tax-free. So if this account is put in the stock market and S&P 500, you can double this amount every 10 years, which means you can retire with a nice, sizable Roth 401k. And then once you retire, you can roll it into your Roth IRA. So that's the way for you to go around it, those AGI phase-out limits, and still be able to contribute into the Roth. This is one of the best ideas for those folks who have extra income. They don't need all of this income to live on, and they can put away a good amount of money before retirement. Let's talk about 403b plans. There is few people that are part of the nonprofit, and nonprofit does not have 401ks, they have 403bs, but those work very, very similar. So there is really not a lot of difference between these two. So 401k, 403b have very similar limit levels, and they work very, very similarly. Simple IRAs, not very popular topic as much anymore, because this accounts usually for self-employed people with small number of employees. They are very rigid and they're not very popular. SEP IRAs are very popular with self-employed people, but if you're self-employed, I suggest to run an analysis, your SEP IRA contributions versus solo 401k. A lot of times, solo 401k might give you a much higher deduction because the contribution limit is the same as 401k, regular 401k, so much higher. SEP IRA is usually 20% of your net income. So let's say you're a realtor and you made $350,000. After all of your expenses of $100,000, you end up with $250,000 of net income from the business. So only 20% of that money can go into your SEP IRA. Okay, so you need to compare. A SEP IRA is a better deal for me than a solo 401k. If your income is very low, let's say you're making $150,000 as a self-employed person and $50,000 are your net expenses, your net income from the business is only $100,000, then you can only put away 20% of it, which is $20,000. Where if you open a solo 401k as a self-employed person, you can put away over $30,000 pre-tax. So you have a better tax savings. So all of this needs to be considered. Tax deduction on defined contributions plans are pretty limited. If you have a very, very good income, one of the great way, let's say you're a doctor, you're a physician, or you're an attorney. A lot of these firms, a lot of these groups establish something called defined benefit plan. It's a pension plan, and pension plan contribution limit is over 200,000. So company make a contribution on your behalf. You're not making any contributions, and you're making it for yourself as an owner and also for your employees. And as there is a special age formula that you use for it. It's a great retention tool for your employees. It's a great tool for you to save a lot of money in taxation. And there is a way to run an illustration and analysis to see if that will make sense for your particular organization. So we talked about, IRAs. So I want you to just be, fully aware that traditional IRA deductions are only fully deductible if your AGI is below a certain level. And you can see that it's a very, very limited levels, right? So a lot of people cannot make a contribution. It's a very nice chart to have. I will make it available for you. And you can see that you can fully deduct it, your IRA, your Roth account, you can for, make contribution if your AGI is over 143, it's below $143,000. For married couple, it's 240, but it's still pretty low. Let's talk about advantages and disadvantages of leaving money in IRA versus Roth. So people who have a higher tax bracket for years, they will benefit from making pre-tax contribution regardless, whether it's an IRA or it's a 401k. And they will not be eligible for Roth. So I do believe that the Roth accounts are valuable, but most likely a lot of people will retire with a small Roth accounts. Where opportunity comes to the IRA to Roth conversion, it's when you feel that you'll be subject to a higher tax brackets once you start taking required minimum distributions. I'll give you an example. A person has $1 million in an IRA and a very small Roth account. And the person decides to retire, John decided that he wants to retire at 62. John also has $500,000 in a brokerage account. And what we decided to do after some planning, that between age of 62 and 70, we will not be touching his IRA account, we'll let it grow. And meanwhile, he will be living off his savings in his brokerage account and his rental income. So his tax bracket is going to be extremely low. As a result, it opened an opportunity for us to start to do IRA to Roth conversion. And each year, we'll be converting $50,000 to $60,000, paying very little tax and moving money from IRA to Roth at the 12% tax bracket. And once John reaches age of 73, he's required to take an RMD from his IRA. But now his IRA balance is not $1 million, not $1.2 million or $1.3 million. It's only $900,000 or $800,000. So his RMD amount is lower, his tax bracket is lower, and at the same time, he's also have some money saved up in the Roth account that grows tax-free. So it's a great advantage for people who retire early, who have limited income. They can put away good amount of money into Roth account by doing these conversions. And conversion is a fantastic way to contribute toward your Roth account and grow it if you have an early retirement age. So conversions is a great way to for you to start looking to convert from IRA to Roth at a lower bracket and continue doing so annually after evaluation of your tax brackets every time you do it. So don't assume that you'll be in a lower tax bracket all the time, but please do know that this opportunity exists for folks with a lower bracket before RMD age. A contribution to a health savings account. It's a great account to have when you're working. A lot of people contributing to that. You're only eligible to put money there if you are in a high deductible plan. If you're not in a high deductible plan, you're not eligible, you cannot put money away. So the family contribution limit this year is $8,300, and you have a $1,000 catch up after age of 55. It covers all kind of medical expenses. Literally anything you can think about medically, you can use in this account to take the money out, from braces to some medical supplies and etc. The money that you have not used up work very similar to your IRA. It will be growing there tax deferred, and you can take all the money tax free. So please use that account if you can. If you're in high deductible plan, it's fantastic way for you to reduce your tax bracket again, right? Because all of this money will be tax deductible. So planning considerations. Pay medical expenses out of the pocket and save HSA for retirement use. Yes, this is one way you can do that. So if you feel like your medical expenses are not that high, but you do like to have a sizable HSA at the end of the day, then you can pay out of your pocket and leave those HSA funds invested like 401k is invested. HSA can be used at any time for reimbursing your medical expenses occurring after the account is open, but please do keep your receipts. And your spouse can roll balance for additional compounding effects. So you can roll those accounts over into one account and you can continue making contributions. So I suggest that if you continue still working and your company has HSA availability, you're in a high deductible plan, please maximize your HSA deductions. Qualified business income, QBI deduction. This is a fairly new. It's a little bit complex. I don't know how many people here are self-employed, So I'm not sure if we should be talking about it extensively, but one thing I do want to mention, then most professionals like lawyers, financial services, people like myself, accountants, they are subject to phase out amount. So once the income is between 380 and 483, after 483, you don't have QBI. But people with not in this line of business, they have a better way to receive QBI. And QBI is a percentage of your wage that can be deducted on your tax return. So QBI has been very, very popular with self-employed people. Realtors use it. A lot of people use that. So purpose of it is to provide benefits similar to a C corporation tax rate reduction. So basically, if you are a S corporation organization, or if you're a solo proprietor, you can have a QBI deduction to bring your tax bracket lower, to bring it on a C corporation level. And this is one of the probably best Secure Act 2.0 suggestions that's been passed into law, and a lot of small businesses using it. If anybody using it, please raise your hand or put it in the chat. I'm curious to see how many people have a QBI out of this group. We talked about long-term capital gain a little bit already, but I do want to mention that you need to keep an eye on your total adjusted gross income. So remember, as I mentioned, if your income is over $583,000, then you are in a 20% capital tax rate. So before you sell your property, before you sell your stocks, please talk to your tax person, figure out how much you potentially can be selling this year, or maybe the rest can be sold next year to keep you in a 15% tax bracket. Very, very important. And also remember, if you're making over 250,000 in AGI as you're married, you'll be subject to this net investment income tax, which we're also trying to avoid. So you see how it's compounding. So we need to be very careful every time we realize the gains, especially in a property sale. Realizing gains and losses. This is just a simple way. You can see the formulas, but I'll just walk you through it very quickly. So each year you might have a capital gain, a capital losses. Give you an example. Somebody bought a stock, didn't like the stock went down, the price, they had a loss, they sold it, and they haven't held the stock more than a year. So let's say they held it for 6 months. They have a 5,000 loss. And then end of the year, your Apple stock did very well. You wanted to cash out a little bit, so you sold Apple stock that you held long time, 5 years, and now it's a long-term capital gain of $10,000. So the question is, how much actual gains will you have to report? Well, every short-term transaction can be offset by a long-term transaction. First, they offset each other, short-term gains against short-term losses, and then long-term gains against long-term losses, and then they can offset each other, which means 10,000 long-term capital gains can be offset by $5,000 in short-term losses. So you will be paying 5,000 in long-term gains as a result. So that's how they work. Short-term capital gains are not favorable. We should avoid them at any cost if we can. And which means you need to work with your financial advisor to be very careful in your brokerage account, not to trade your account too much, not to rotate it too much. Otherwise, you have quite a bit of gains without any use of the money. So tax efficiency in your investment accounts is extremely important, because it's not what you earn, it's not what you make, it's what you keep. So if you made 20% return, but after paying all the taxes and all the transaction costs, you might end up with much, much less number in return that you originally started. So keeping in mind that short-term capital gains are no, and long-term capital gains needs to be controlled. I don't want to go too much in details on the wash sale. I do want to mention that if you're trying to buy and sell the same stock within a very short period of time, you need to be aware of something called wash sale. Wash sale is when the losses are not recognized. IRS says, hey, you bought it, sold it too soon. We will not let you realize the loss, because we know that you just sold it for a reason. You wanted the loss, but later on you bought it and now you're at gain. So be careful about wash sale. It's something that we need to keep an eye on. All right. So let's talk about a couple other things besides the wash sale. Equity compensation may provide tax advantages. One of the ways to look at it is at your restricted stock units. A lot of people these days don't get a lot of non-qualified stock options and other type of stock options, but restricted stock units are very, very popular. And once they vest, it becomes an ordinary income. However, after the date of vesting, when the stock becomes yours, you do not sell it and you hold it for 1 year or 1 day. If you sell it later, the difference between the fair market value at the time you sell it and the price at which you vested, let's say you vested at $100, now NVIDIA is at 800, so that difference is your long-term capital gain if you held the stock for more than 1 year and 1 day. So long-term capital gain treatment for your stock position is extremely important. If you decide that you need the money sooner and you want to sell it, then my suggestion is maybe sell it soon after the vest, because if you sell it soon after the vesting just completed, then most likely you will not have a lot of capital gains to pay as well. But you are due ordinary income on any RSU compensation in the same year you receive it. There is a couple other stock benefits that we can talk about: qualified disposition on incentive stock options, 83B election for restricted stock grants. What I do want to mention that these are very specific and very complex situations for which I believe you should consult your tax preparer and your financial advisor. There are some advantages when you receive non-qualified stock options, either to hold them for 2 years after the grant and 1 year after exercise. Sometimes you can do 83B election, which is tax advantageous, but you need to be very careful with that, because you don't want to owe taxes. You may pay ordinary tax on a lesser value and potential capital gains in the future, but if a stock price goes down, that might not be advantageous to you. So you have to be very careful, and before you exercise any of these strategies, please talk to your tax people. Let's talk about tax return on bonds, because bonds been lately a very hot topic. If you hear from your financial advisor or you read articles, you can hear people talking about how great the bonds will be going forward. We haven't seen it yet this year. Bonds are not doing that great, but expectations, because bond prices come down so much and interest rates now are most likely will go down, not up. Bonds will improve in price, plus they now pay good yield. So as a result, especially municipal bonds and other type of bonds become very attractive. Now, please pay attention that the higher your bracket is, the more yield you will be required to net a certain dollar amount. So if your taxable bond pay, let's give an example. Let's look at married filing jointly, people who are in a marginal tax rate of 22%, right? A lot of people are. So if you're making 5% yield, right? So you can see it right here, 5% yield in a 22% tax bracket. Your after-tax yield only 3.9%. So you need to ask yourself, if you're in a 22% tax bracket and your municipal bonds pay you 4.25%, is it better than if you buy a taxable bond for 5% or if you put money in money market? People think that they put money in money market or savings account that pays 5%, that's what they keep. No, they will not keep that. They will keep much less. They will keep 3.9%. So you always need to compare your after-tax yield with the municipal bond yield. And a lot of people in California will benefit from that. We'll talk about tax efficiency real quick. I just want to bring something to your attention on a couple fronts. Please pay attention to qualified dividends. Qualified dividends also taxed at the long-term capital gain rate. And that's, if you hold the stocks long enough, then you can have quite a bit of qualified dividends, so you don't have to pay much tax on. So qualified dividends have an extreme importance in your portfolio construction. Tax-exempt bonds, ETFs, mutual funds, extremely important for Californians because we have a federal and state heavy taxes, right? I would suggest only do actively managed portfolio that's trading a lot in your retirement accounts, because they're not subject to taxation unless the money are taken out of the account. But you have to be very tax efficient outside of those accounts, in your brokerage accounts. A Roth account also not subject to taxation. You can be actively managing that account as well. I don't want to go in over kiddie tax, but I do want to bring something to your attention. Maybe not everybody knows. 529 plans a year and a half, 2 years ago, right, when the Secure Act 2.0 passed, said that now you can roll part of your 529 and used portion if you had 15 years or more in the 529 plan into the participant Roth IRA up to a certain dollar amount. It's a great opportunity if kids haven't used all the money. Instead of leaving money in 529, you can help them roll it into their own Roth accounts. It's a great way for kids to establish their Roth accounts, make contributions after college. It's a great feature that you can consider. So, and itemized deductions, well, we can see the standard deductions here went up slightly. Itemized deductions, unfortunately, we were so hoping that legislation changes will appear at the beginning of this year. We were hoping that the SALT taxes limitations will go away. They have not gone away. Our SALT still capped at $10,000, which probably one of the most painful changes we've ever, sorry, I was trying to highlight, we will ever try to see. Because if you remember previously, we can deduct our property and state taxes unlimited, right? And if your state taxes are high, you can have 50, 60,000 deduction right there. But today, that's only $10,000. So it's really a killer to a lot of Californians. It brought our tax brackets much, much higher. Mortgage interest rate deductions up to $750,000. Mortgage is still deductible. Charitable contributions are deductible. And medical expenses are over 7.5 if AGI is also deductible. So do look into itemized deduction as much as you can, a lump sum, your charitable contribution. And if that's all doesn't work, consider moving to different state. So you can see California is a red, very dark red, which means we're one of the highest tax brackets compared to New York and others. The states that are in gray, they have no state taxes. There's few. You can see Nevada, South Dakota, Texas. So those are options for retirees of Washington State. So you can think about if you're retiring and you don't mind moving, would it make sense for you not to pay state taxes? But don't be too fast to decide on it, because those states who don't have state taxes, they might have a sales tax, or they might have a not favorable estate tax, right? We call it death tax. So you need to evaluate all that kind of taxes before you make a move. Not only your state taxes, your sales taxes, you also need to see if there is an estate tax issue in your state. So once you evaluate all of that, then you can consider moving. But obviously, California is not the easiest state to live in tax-wise, though we enjoy our weather here. So this says proper steps to take when relocating. I don't think I want to focus on it. I mean, definitely there is a lot of things to consider. One of them would be your ability to, if you ever leave California, if you want to come back, how are you going to do it? Because usually there's property taxes. You cannot carry it back. You only can carry back your property tax if you're having a lower property tax level currently. You can only carry it within the state tax. Within the state. So if you $4,000 property tax, you're living in a $2 million home. If you sell the property and go within California somewhere else, then you can carry your property tax with you. But once you move out of the state, it's gone. And you have 2 years to bring that. You have 2 years to buy the property to carry your property, low property tax basis. So very important and very big consideration for those who've been living in that property for years. So this is showing that you can see that the tax rates, states with reduced tax on capital gains, states with reduced tax on retirement income. So there's few states that you can consider. If you like Hawaii, definitely capital gain tax rates is lower on the state level. And you can see that there are some states like Colorado or Illinois that have reduced tax on retirement income. We're talking about RMDs, we're talking about all kinds of income like that. Right. So a couple last slides and then I'll open up for Q&As. So mortgage, we discussed it, so you can deduct part of it. Charitable giving on the rise. People like to set up something called donor advised funds, DAF, and those allow you to put a large contribution into the fund fully deducted the same year, and then use many years to direct that money toward charities. Great way to do it if you're charitably inclined. I think it's an excellent tool to use. Now, I would like to wrap it up. I just want to ask if anybody has any questions. We talked about bunching itemized deductions. I can go over that a few more times, but why don't we go over some questions, and then I will maybe finish it up with a few more slides at the end.
Thank you, Larissa.
Thank you.
There was one person who indicated that they take advantage of the QBI.
Oh, perfect. So there is one person. I'm surprised it's only one person out of that group, but it's great because QBI is something that you should not miss if you're below those brackets. Great job. Excellent. I'm glad to hear it. I am not able to do it, so I'm glad someone then, yeah.
Do you know if there is any talk about whether that will change after 2025?
They haven't
advantages.
discussed it, no. This legislative environment has been very slow. This is one of the slowest legislative environment we've seen in years. In the last 2 to 3 years, we saw very, very few tax law pass. Used to be very active. And now with this government, we are not seeing a lot of changes. We were hoping the change will be this year in January. Nothing passed. Nothing passed. There was a lot of discussions. So I think QBI will stay. We really want to have a salt limitation go away. That would be very advantageous, right?
Okay.
But not yet. But there will be a sunset. Remember, everybody, remember 2026, that there is no new law pass between now and January 26th. We will have a phase out, and this law will go into the old law, and the SALT deduction hopefully will disappear. SALT limitation hopefully will disappear. So we still have a hope here.
So is the SALT due to expire after 2025?
26. Yeah.
Oh, okay.
23.
Okay.
Yeah. SALT and few
Okay.
other provisions, not only this one. Yes.
Okay. Yes. Okay, so Abby has a question about her side gig as a freelance writer. Do you want to unmute yourself, Abby, and ask the question? And if anybody else has a question, feel free to enter it in the chat box.
If we have a few questions there in the chat box.
There was a question from Mick about capital gain income tax for California. What is the rate for that for California?
Highest rate is 11%. 11%.
Okay. Oh, so somebody asked if they can get a copy of the presentation.
Absolutely, absolutely. I make it available in the PDF document, and we'll send it out with proper disclosures to to Lisa.
Okay, thank you. So, and I will then forward it to everybody who registered for this program, and I will also include the link to this recording. Okay, and yeah, go ahead, Larissa.
No. I'm surprised nobody asking about charitable. A lot of people I know try to take advantage of deduction like that, but it's okay. I mean, we can talk about it a little bit more if there is an interest.
There is a question from Francis. Is there a general strategy for charitable giving from a tax perspective?
General practices, they're asking? Charitable giving?
Yeah, a general strategy.
General strategy. I think the best strategy is, if you're charitably inclined, you need to consider two things. First is, if you're able to make this contribution out of your IRA account, you're eligible to do it at the age of 70. So let's say you are 70 and you're making a 15,000, 20,000 contribution each year. I suggest do not do it out of your regular account. Keep your regular account invested. Do it out of your IRA account. Because if you do it out of your IRA account and you're 70 or over, all the distributions from your IRA comes tax-free. So you don't, for charitable contributions, so you don't have to pay any taxes on distributions. Number one. Number two, if you're younger and you have charitably inclined making sizable contribution each year, consider donor advised fund. Then in a year when you have a higher income, you can put some money toward donor advised fund and control your tax bracket, and you can continue doing so. And then you will direct your charitable contributions towards certain charities on an annual basis anywhere you like. So it's a lot of flexibility for taxes. This is my kind of rule of thumb. So charitable contributions also needs to be lumped if they will give you advantage for itemized deductions.
Okay. And does do those contributions count as part of your RMD?
Yes. So at 73, you can, instead of taking RMD out, let's say you don't need it, you can direct it all toward charity, and that will be considered your RMD requirements been satisfied. Yes, which is a great strategy. Great strategy.
Mhm.
So charitably inclined.
Okay, excellent. Is there any other strategy if you're not yet at that age to, where you're required to take RMD?
So yeah, RMDs is difficult to avoid unless you're making contribution toward charitable cause. What people do is let's say your charitable contributions are 15,000, but your RMD are 40. If you have a sizable account, then people try to take as much out of the IRA for charities, and then remaining will usually be taxed, but it can go into your brokerage account for reinvestment. You don't have to spend it if you don't want to. And then
Okay.
can be invested with tax aware strategy.